Economic Capital Framework was adopted in April 2019 based on the recommendations of Bimal Jalan Committee. It is a part of enterprise-wide risk management framework of RBI. So it basically lays a methodology to determine how much amount of funds should be kept with RBI for risk provisioning, and also how much amount should be transferred as profit to the central bank. That is the surplus distribution. And this surplus transfer is also governed under section 47 of RBI Act 1934. So let's see what are the key sources of income for RBI. RBI earns interest on the government securities. It also earns interest from the liquidity management, that is through liquidity adjustment facility. It gives loans to banks whenever they need to adjust their liquidity, and it earns interest on them. And it earns interest or income from the loans and other advances. RBI earns through seigniorage, that is the profit it gets by printing the currency. It also gets interest from the forex reserves or other foreign currency assets it maintains. So the profit generated through all these income sources would be transferred to the government. And under the economic capital framework, these are the key parameters which are considered to allocate the funds. So first one would be the realized equity. This is nothing but the current amount of funds held by the RBI. It includes capital reserve fund, contingency fund, and the asset development funds. And the next parameter would be contingency risk buffer. It is a part of realized equity. It is maintained as a safeguard against various risks like monetary risk or credit risk, etc. And also some unrealized gains or losses would also be considered while evaluating the economic capital framework. So this framework must be recommended to be reviewed once in every 5 years. So by evaluating all these parameters, economic capital framework decides how much funds needed to be maintained with RBI as a capital reserves and how much funds should be transferred to the central government as profit. So that's it.